Let's bring in Paul Sankey of Sankey Research. He was ranked by Institutional Investor as #1 for independent energy research in 2023. Paul, great to have you with us.
Hi.
Way back when, I think it was at the end of last year, you predicted oil to 120 sometime this year, I believe it was. Do you stick by that?
Yeah.
I mean, is that even more likely? Does it go even higher?
No, that call went wrong, quite frankly. That was because we anticipated more winter in Europe and we anticipated a lot less oil from Russia. So I think we're looking towards more of 100 now. It was a driving season call. So the idea was that by Memorial Day, we would get to 120. That's far too high, I think, now, based on the economic weakness that you guys have been highlighting with the ISM number today. So I think 100, the key thing here is Saudi wants higher prices, and they've basically said 95 is what they aspire to. They haven't specifically said that, but that's what we're kind of led to understand. So I think that would be the next target, definitely.
95 seems like a long ways to go from here if we are to believe that, you know, there is a push lower by economic slowdown. I mean,
yeah.
it almost seems like more cuts are on the table and likely to come if 95 is the price that they actually want.
Yeah, but you have the natural rise in demand here because of seasonality. So you go into driving season in the US. You also have a lot of refineries to come back online. They're going to suck up more crude. So the crude market will be tightening naturally, seasonally. And then you've got to remember that the global demand drivers are less economically impacted by the US nowadays. That's really part of the multipolarity world that we're living in. And so China, for example, is coming off a structural COVID low, more air travel. That's not going to be too economically sensitive. India's doing great. I was actually looking at Brazil demand numbers, and they're strong. And what's interesting, particularly in the case of India and Brazil, for example, is both of them are having all-time record oil prices in local currencies. So the demand strength globally seems like it's still there, and that'll be what drives us higher.
Hey, Paul, congrats on the award. You know, I guess the other thing I just ask is, does today's announcement do anything to how we should be investing in oil companies? Is this going to change their attitude, their behavior? What does this headline mean to investing in the energy sector that's rallied back, but still, you know, people are questioning where demand is?
Yeah, I mean, the first principle is demand. But at the same time, we had talked about two puts, again, somewhat wrongly. The first put was the Saudi put, and that's them essentially here managing to keep a secret, actually, OPEC. They stunned the journalists whose job it is to find out about these things. I'm amazed. You never normally get an OPEC deal like this that's such a total secret. But obviously the Saudi put. But the second put was the Biden administration's theoretical put that they would start rebuilding, as you referenced, the SPR once we got down to 70, and they simply didn't. And that, of course, adds to the kind of negative perception. But now that the Saudi puts kicked in, I think that you do have a better valuation support for the names, which, as you say, have got very cheap. We thought that when oil was last at 85, they were discounting about 85, but then you had the airdrop in oil as a result of the banking crisis. And I think with very low speculative interest, essentially a high short interest in oil, very few longs, the Saudis decided to step in and squeeze the market back to where they want it. And it's very much for their own reasons. You know, it's for domestic spending reasons that they want this higher price.
So, Paul, in this environment, where are you better off being? The legacy integrated names, refiners, the levered names, or names within the OIH? How would you sort of layer into that group?
This is a tough headline for refiners, right? Because you're squeezing the crude market higher, which obviously squeezes their margins. And the refiners have been significant outperformers in the energy space. So we would say it's relatively negative refiners here. The one that people want to buy, quite rightly, is service companies. That's the most juice, particularly international service, names like Schlumberger, Baker Hughes, but also some of the domestic service names. Because you've got to remember that whilst typically an OPEC cut is seen as bearish because it increases spare capacity, global oil production capacity really has a problem. And we really only have growth in Guyana outside of OPEC Plus and almost nothing else to speak of. So structurally, the market to me looks like it'll be a $100 market in the future simply by lack of supply growth. And then amongst the names, obviously, you buy the juiciest E&Ps. You mentioned Oxy. And then as you go down the capital structure, the smaller names obviously will do better. So it looks good for US E&P companies.
We always ask you about a pairs trade, Paul, and so I'm curious what you would put on, what you'd be looking at now, given, we sort of have like this floor under oil prices a little bit, and we've got a NASDAQ that's been up 11% over the past month or so. I mean, anything new to tell us?
These are always notional, right? So I think we'll short Nvidia, and we could go long Oxy. Let's say Oxy, short Nvidia, long Oxy.
All right, it's a good one. Yeah. All right, Paul. Always good to see you. Thanks.
Pleasure. Thanks.
Paul Sankey, Sankey Research.